Thank you, Nir, for the invitation. It's a pleasure to be able to join you. It's amazing to see this program and the speakers you've had. And so, I'm really grateful for the opportunity to join this. And I'm just excited to see these kinds of activities taking place. I want to talk about a kind of new piece of work we're working on here at Carnegie Mellon. It's called Automated Exchange Economies. It's with my colleague in the finance group, Brian Rutledge, and a grad student of ours who's in economics here at the Tepper School of Business, Yikang Shen. So who's doing really great work, and we're really excited about his prospects. I'm an economist by trade, and one of the first things you learn in economics about, in microeconomics is how people trade, and we think about Edgeworth boxes and exchange economies. And as we started trying to understand how trade is taking place natively on blockchains, we thought it would be worthwhile to take a Edgeworth box perspective to understand automated markets. And so we're trying to dive under the hood and take a very micro perspective to understand how automated market makers actually function. And so that was kind of the goal and spirit of this research that I'm going to present to you. In a nutshell, this is what this research paper does. When we think about liquidity provision on decentralized markets, the conventional view, which dominates the nascent literature growing here, and a lot of what you see online when people describe how markets like Uniswap work, is that providing liquidity in automated markets is a passive activity. Passive liquidity providers can stake their portfolios of tokens and earn some fees subject to some threat of some costs, which we sometimes refer to as adverse selection or impermanent loss. We're going to question this conventional view directly. I'm going to try to show you that actually a fair number of liquidity providers, people who supply liquidity to automated markets, are quite active. And what I mean by that is they will take actions that directly influence DEX prices. Now, from the perspective of, say, Uniswap v3, this isn't surprising, right? Uniswap has been changing its strategies of the markets they designed to give liquidity providers more control over the prices at which they trade. But I'm going to show you, even in the context of v2, liquidity providers actively undertake transactions that influence prices that are prevalent on the DEXs. So even in this constrained space, they are quite active. And when you think about liquidity providers being active and actively setting prices, you have to walk away from this conventional view that liquidity provision is passive. When we say liquidity provision is passive, we usually think, well, markets are made on centralized markets. That's where price discovery happens, and there's continuous arbitrage to the DEX that sets the price on the DEX. But if we think liquidity providers are actively setting prices, it means that's not the direction information always flows. And so we're going to move away from that. Dahlia, please interrupt. I would appreciate questions as we go.
Yeah, so you guys are the economists. Can I ask, if I took this slide and removed the D from everything else, it's not decentralized, would the same hold for traditional markets? Liquidity providers are anything but passive?
Yes, this is the normal perspective on centralized exchanges, is the market makers are the sophisticated active price setters. We don't think about market makers in traditional markets as passive. Now, what's distinct, of course, is on Uniswap, you can't literally directly set prices. But if you read most of the literature about DEXs so far, the view is there's pure price discovery on some centralized exchange that's continuously arbitraged to the DEX. And because of that, if you try to adjust prices on the DEX, it will instantly get arbitraged back to the price that's discovered on the centralized exchange. And therefore, there's no role to set prices on the DEX. We do see liquidity providers, market makers setting prices. And so when we work towards a theory of active liquidity provision on DEXs, we're going to start thinking about limits to arbitrage. So we're going to assume that pure price discovery doesn't happen. Along those lines, as I said, we're going to build and develop the simplest micro dynamic theory of active liquidity provision on DEXs, subject to the constraints of, say, Uniswap v2. And we'll try to use the model to better understand some of the features we see in liquidity provider behavior on Uniswap v2, and try to extract some implications for the optimal DEX curves that we see implemented. So we're going to get some new ideas about what the optimal shape of a DEX curve might look like. We're not going to go all the way to optimal design of a DEX curve, but we'll ask and uncover some new trade-offs for that issue. That's our paper in one slide. I did my PhD at Minnesota. Our favorite phrase is, let's get to the model. I want to do that on the next slide, but I have to first try to convince you liquidity providers are active. So I'm going to start with some data. One last bit of maybe, what is this paper useful for more generally? We're going to go to an extreme and assume there is no such thing as perfect price discovery. There is not a centralized exchange where I can look and extract the perfect price. One way to think about this is that price can't be arbitraged instantly between the centralized and the decentralized exchange. That's a reasonable assumption, right? Moving tokens across those exchanges or storing capital in both locations to take advantage of spreads and prices is not free. So it's not literally an arbitrage. And second, as all of you here know, there are lots of tokens that don't even trade on centralized exchanges, which do trade on decentralized exchanges. The only place to trade them is on a DEX. So in a world without some pure price forcing process, what does market making on DEXs look like? We're going to provide a theory that can help shed some light on that. So that's the goals of this paper. Okay. Let me start by what I mean with active liquidity management. And for most of you, I imagine this will be quite straightforward, my lay description of how a DEX like Uniswap v2 works, but I think it's helpful to show you how we're going to take a lens to interpret the data. So as you know, like market making by DEXs works distinct from market making on a centralized exchange. Instead of posting bid and ask prices, limit orders, taking this large volume of messages and looking for matching orders, instead a DEX works differently. A market maker supplies a portfolio of tokens to a smart contract. The smart contract embeds some kind of pricing curve, and then traders can come along and swap against the pool the market maker has supplied. When you look at underlying code, the smart contracts that govern a DEX, there are really two key functions of this code. The first is a set of rules that governs the provision of liquidity. So this is a rule that allows, say, a market maker to supply in positive quantities amounts of both tokens A and B. This could be ETH and USDC, for example. It also dictates the rules governing the withdrawal of liquidity from the pool when they want to subtract both of those tokens. And so, of course, you look at the Uniswap v2 factory code, you will see this directly, right? The mint and burn elements of that contract directly govern when you supply tokens, how do we account for the share of the pool you've supplied? When you withdraw, how do we dictate how much you're allowed to withdraw given your liquidity pool tokens? The second key function in the code is a liquidity taking rule, which dictates how traders can swap against the current pool. So in particular, you could swap A for B. A trader could deposit some of A and withdraw some of B, or vice versa. And so we need a set of rules dictating how that trade works. What most of us have focused on are these liquidity taking rules. When these swaps occur, we've all seen this constant product pricing function that is kind of the most dominant, although it's not the only one. It's a useful starting point to understand. When we define a rule that says if you deposit 1 unit of token A, how much of token B can you withdraw? What we're doing on the margin is defining an implicit exchange rate. What is the rate at which you can swap 1 unit of A for some amount of B? The constant product rule, which I'm writing here in the center, just tells us that if I have some pool of tokens that has quantities EA and EB in the pool, if you deposit some amount QA of token A, the amount of QB you can withdraw ensures that the product of the quantities of tokens in the pool stays constant. Again, I know many of you know this already. I just want to go slow to make sure we agree. Now, it turns out, given this particular rule, on the margin, the relative price, how much QB you get for 1 unit of QA, happens to be the ratio of tokens that started in the pool, EB over EA. My point is that we have this pricing function, and given some supply of liquidity, that defines a marginal relative price between the two. And so as liquidity providers supply more or less tokens in different ratios, they're distorting the relative price that traders will face on that market. Visually, I think it's helpful to see this. A liquidity supplier might deposit some amount of tokens A and B. I can just visually interpret that. I'm going to have quantities of token A on the x-axis, quantities of token B on the y-axis. Suppose the liquidity suppliers in aggregate have supplied this amount of tokens to the pool. We define our pricing curve through that point. This is this hyperbolic curve you've all seen if you've looked at any documentation on Uniswap ever. And the key idea is that the slope through that point defines the implicit marginal price between these two tokens. It's going to be useful, I think, to visualize this. Instead of visualizing it, it turns out, sorry to go back and forth, instead of the slope of the curve at that point, it's just minus EB over EA. We can also see it as just the ray from the origin. The slope of the ray for the origin also gives us that marginal price. So again, a liquidity supplier, by making a deposit, establishes a relative price between the two tokens. I want to come back now after making markets to these two functionalities of swapping A for B, B for A, versus minting, adding both of A and B, or withdrawing both of A and B. When a trader comes and swaps at a DEX, what they're doing is sliding along this curve. So in this case, our trader is withdrawing some of token B and adding some of token A. And we see immediately, this is the reason I wanted to show you, we can see implicit prices as the slope of these rays. Immediately, we see how the implicit prices now change. By withdrawing some of token B, they're making B relatively scarce in the pool. This is how the curve was designed. It's going to make it more costly to extract some of B in the future. By construction, swap transactions directly impact prices. And this has been a lot of the focus of the literature on DEXs so far. Now, when we think about mint and burn transactions, and this is a detail in the Uniswap factory code, formally, Uniswap factory code says you must mint or burn at the same current prices in the pool. The Uniswap factory code says, as a liquidity provider, I will only reward you with pool tokens to the extent you mint or burn along the same ray from the origin that the pool is at before your transaction processes. And because they keep you on the same ray, if our liquidity provider comes along and adds some liquidity to the pool, they shift the whole curve out, but they do so at the same relative price. Now, of course, we all understand as students of blockchain, when you create a transaction, I want to add liquidity to the pool, you don't know exactly the order in which your transaction will be processed. So it could be that a swap occurs and then your transaction processes and you're at a slightly different price. In the data, although I won't show you this today, it turns out liquidity providers are very good at supplying at prevailing prices. They almost always mint and burn in ways that don't impact the relative price. And so I think this makes you instantly start thinking, well, liquidity providers, when they add and withdraw liquidity, they make or close markets, they're not really impacting prices. But if you're an active liquidity provider who wants to do it, what could you do? Suppose the current state of the pool is at state 1, and you're a market maker who wants to add liquidity to the pool, but you think the price in the pool is quote unquote wrong. Well, if you mint liquidity along this ray, you're not changing the price. But what could you do? You could first engage in a swap against your own pool, change the price, and then add liquidity. And so when I'm going to tell you, I want to use this as a lens to evaluate the data, what I'm going to do is start asking, well, when I look at liquidity providers, do we see this type of behavior? If I look narrowly at liquidity providers minting or burning liquidity, I won't see them changing prices. But if I take a more holistic view of wallets of liquidity providers, I can start asking, do liquidity market makers, liquidity providers, swap against their own liquidity when minting or burning? And if so, I'm going to take that as evidence that they are actively changing or distorting prices on the DEX. So with that background, I'm going to jump into the data. Are there any questions about how we're going to approach this? No? Okay. For today, and Nir asked if this paper was available online yet. It's not. I hope to have it up in the next week or two, at least the first draft that we can share publicly. For today, I'm going to look at a very narrow slice of the data. I'm going to look at 6 months at the start of 2023. Exactly which period you look at for Uniswap v2 pools will change some of these numbers slightly. But the broad message, as we've looked at wide swaths or narrow swaths, seems to hold. So first, what am I going to do? I'm going to look at the largest 24 pools. These are pools that have reserves over $5 million worth of value over this 6-month period. So these are large, serious pools. They're not tiny meme tokens you've never heard of, okay? What I'm going to do is I'm going to look at all wallets that interact with these pools. And I'm going to try to classify wallets as liquidity providers or liquidity takers, market makers or swappers. And I'm going to do it in the simplest possible way. I'm going to look at a wallet. I'm going to say, if you deposit liquidity to the pool over this time period, or you withdraw liquidity from a pool over this time period, or you own a pool token from one of these pools, then you're a liquidity provider. If you don't do any of those, then you're a swapper or a liquidity taker. And so if I look at wallets at these largest Uniswap v2 pools over this time period, what do I find? If I look at transactions by these wallets, first, you see immediately our swappers do 1.2 million transactions. Our liquidity provider wallets do 36,000 transactions. Market making is not a very high frequency activity. Compared to our swappers, it is absolutely the case that market makers, liquidity providers, are inactive participants in this market. So when we say market making is passive, I agree 100% that it's not something they are doing day to day. But what I do see when I look at these liquidity provider transactions is they don't restrict themselves to deposit and withdraw. We see a sizable number of transactions where market makers swap against their own liquidity. Please, Dahlia.
Yeah, these are transaction counts, but what about the value?
I'll come back to that in a bit. I'm just starting with raw counts, okay? That's a great question. So first, I just want to say, we see liquidity providers do swap against their own liquidity. That's the first count, right? I want to be clear, we're not doing any forensic accounting across wallets. We're just looking at the raw wallet data. My first instinct was we wouldn't find anything. We wouldn't find any swaps that liquidity providers might use other addresses to try to do it. We'd have to link these wallets. We're not going to do any of that. We're going to take the raw data as is. I think we could find more if we tried to do forensic accounting, but we're not so interested because we find enough of this.
I have a question. Is this data is from the version 2 pools?
Yes. We're looking at the 24 largest version 2 pools over this 6-month period.
I see.
Again, in version 3, my lens to look at the data is more complex because in V3 now, liquidity providers can directly control the prices at which people trade against them. So in that sense, every time you engage, you have the ability to directly set pricing. And so for that reason, it's not surprising they're active. It's, this lens has more bite in V2. So that's why we're focusing on V2.
Just because if we are speaking about raw data, I think that maybe something in the liquidity providers is more showing the more active liquidity providers, because in version 2, a lot of passive liquidity providers start providing liquidity even before. And I think that those guys that are totally passive will not really appear in 6 months.
Let me answer your question directly by focusing on the liquidity providers. That's actually my next slide.
Okay, perfect.
So my first claim is liquidity providers are inactive. That is perhaps not surprising. Now I'm going to zoom in on my liquidity providers, and I want to try to classify them by how many actually engage in swaps against a pool and how many don't. And speaking to Nir's point, we see heterogeneity here. Over this 6-month period, I have roughly 4,000 unique trader addresses that I classify as liquidity providers. Roughly half of them engage in some kind of liquidity taking transaction. Roughly half of them do a swap against one of their own pools. Roughly half of them do no swaps. So I'm going to classify these, the ones that do no swaps, as passive liquidity providers. They mint or burn some liquidity, they walk away. But half of our liquidity providers seem quite active, okay? So that's going to be my classification. So we do see a mix in this pool. We do see some heterogeneity. Interestingly, I don't know exactly when, I haven't used the Wayback Machine, but Uniswap today now, when they describe liquidity provision, they divide it in two. They say there are passive ones who just passively stake their portfolios, and then there are more sophisticated active traders who directly set prices. And so that, Uniswap a year and a half ago when we started it just said liquidity provision was a passive activity. Today it looks a little bit different on their GitHub. And so I find that interesting that they now think about these providers as active. We see a very clear cut of that kind of heterogeneity. Now, another way to see this heterogeneity, if I look by address and I ask what fraction of all of your pool transactions are swaps against your pools, when I look at my liquidity providers, I see a lot of heterogeneity. Some are about 75% of their transactions are swapping against their own liquidity. There's a big chunk here around 30%. So the point is, even among active provision, we see a fair amount of heterogeneity. Now, to me, what I argued was I want to see evidence of liquidity providers setting prices when adding or withdrawing liquidity. So what I'm going to try to do is look at paired transactions. I'm going to try to look for liquidity provider addresses who engage in some kind of swap and then mint within a window. And for this table, I'm going to do it within a 3-minute window. The results are not very sensitive to whether we zoom into a block or we zoom out to a little bit of a wider outcome. And what do I observe? And what I want you to focus on is this column in the middle. I'm looking at active liquidity providers, and I'm going to look at their minting behavior when they add liquidity to the pool. And what do I observe? Of my 4,000 active liquidity provider minting transactions, about 1,000 of them are naked, meaning I can't find a swap around this time. Those are mints where they add liquidity and don't set prices. They take prices from the DEX as given and they leave the price alone. But I see 3,400 cases where they swap and then mint. I see 3,400 cases where they actively trade against and then supply liquidity. And so I'm going to interpret this as 75% of liquidity provider mint transactions among active liquidity providers. There should be active here. Apologies. 75% of active liquidity provider mint transactions are paired with a swap within a very narrow window. And so I'm going to interpret this as our liquidity providers are often choosing the price at which they choose to supply liquidity. Now, Dahlia, I have to apologize. I said I would talk about it. I unfortunately don't have the table here today. When I look at
Right. Well, but can you
magnitude,
give us?
no, that's what I was about to answer.
Yeah.
When I look at the magnitudes of the price impact of their swaps, they're the same order of magnitude as the average trader's price impact of a swap. So I don't know if that's big or small. I know it's comparable in size to an average trade. So it's not they're doing an epsilon effect. They're doing a comparable to any average trade, which I take of as it's a meaningful change in the price to the extent we're seeing this. One way we're
No,
trying
but that
to
means that means they're not dominating. I mean, it could be that all of the noisy traders do small swaps, and then these liquidity providers are really swaying the price with giant transactions. But this is not the case. You're saying they're okay.
I take it as it's not that the liquidity providers are just small bits of noise compared to traders. It's not that they're dominating compared to traders. It's about the same. So if we think traders have price impact, our liquidity providers have price impact. If we think not, that's the best way I can think to measure that effect. There is, of course, heterogeneity across pools. There's a lot of different issues you might want to uncover trying to kind of go deeper into the quantities. Again, we just want to think about active liquidity provisions. So that's why we're focusing on these counts, because it just says they do seem to act in ways that impact prices. And so for that reason, we're going to try to build a model that can capture, what does liquidity provision on something like Uniswap v2 look like when providers have a role to actively set prices? That's the jumping off point for our paper. That's all I have to say about data for today. Are there any questions before I move on?
Yeah. So the 24 pools, all of them are include tokens that are available to trade on centralized exchanges?
My understanding, my recollection for these 24 pools, yes, that's true.
I see.
It's a mix of stable coin.
Yeah, because I'm not sure if you get this table by pool, do you see same pattern or there is a token type impact?
So, I mean, it's going to look a little funny on a stable to stable pool. But when we look at token to token or token to stable, we see similar roughly results.
Yeah, because so I think okay, it's related to your point about the theory aspect. I can see why they will do it when they want to arbitrage sex prices, but the question is what going to happen in a where there is no centralized exchanges.
So the theory will speak generally to all of this, assuming there's some limits to arbitrage on a centralized exchange.
Okay.
The data, you'd have to take a closer examination. I agree. Okay. So with that, now we're going to do is the easy bit, which is some theory. Okay, so I want to try to build a dynamic model of liquidity provision on a decentralized exchange with active liquidity providers. And why I say it's the easy bit is because, like I said, I'm going to go back to use the oldest kind of tool economists have access to study trade, which is Edgeworth box analysis, effectively. And so when I say that, I'm going to tell you, I'm going to build what we call a 2x2 economy in finite time. So 2x2, I'm going to have two agents, a market maker or liquidity provider, and a trader, and two assets, token A, token B. Going back to Dalia's question about could this apply to anything, this could be apples and bananas. I know you're asking specifically about centralized, decentralized. This need not be crypto. This could be apples, bananas. This could be any market design. I'm going to apply it thinking about, crypto tokens, but I'm going to use A and B, think apples and bananas. I'm going to have two risk neutral agents. I'll tell you why I assume risk neutrality and where I think it might matter later on. But for now, let's take two risk neutral agents. I'm going to have a liquidity provider. If you like, think of her as Alice. She initially owns some quantities of tokens A and B. And then I'm going to have a potential trader, really a large number of traders in every period. I'll call them Bob, who can trade using our AMM. Within each period of our environment, our game, we're going to have the following timing. The liquidity provider makes a decision of how much of her endowment of tokens to deposit at the AMM. After she makes her deposit, there's potential some public information about the value of the assets can be realized, at which point our liquidity taker, Bob, will be able to trade at the exchange. So before I get to my implicit assumption, what does this timing reflect? It reflects the idea that market makers are inactive. And my assumption here is that means why are they inactive? I'm going to assume because they think they are kind of slow-moving capital relative to traders. Why would I lock up my liquidity in a smart contract and have to withdraw it before I can do anything with it? Because I think I'm not very good at kind of high-frequency arbitraging the market. So my assumption is that Alice, our market maker, is slow-moving capital. She understands that once she posts, there's a chance someone with superior information will trade against her. That will turn out like a form of adverse selection or a form of what we're used to calling here impermanent loss, but it won't be because of hidden information. She won't be learning from anything. All information will be public.
So can I ask again a dumb question? So you're saying there's an implicit assumptions that liquidity providers are slow, are all the things you said, but isn't the basic assumption that without them, so anybody actually looking not just to preserve their own wealth or do something conservative, anybody actually interested in this game and in investing knows that without liquidity provision, nothing will happen. It's an enabler. Isn't that their goal?
They are an enabler, and they will get compensated for creating the market.
Yes.
But they understand that they face a risk when providing this market that someone may be able to trade against them with superior information. The assumption is that Alice won't be able to withdraw her deposits after the realization of public information before someone can trade against her. That's the sense in which I'm going to assume she's slow. Once the trade happens, she can then update her deposits. So we're going to assume she can make updates from time to time, just not instantly correlated with the arrival of public information. Again, the starting point for our paper will be there will be gains to trade here. And so our market maker will be compensated for making the market. They just may sometimes face a cost. Now, the second implicit assumption I'm not going to formally write down is if you believe some perfect price discovery at a centralized exchange, we're going to assume no perfect arbitrage. So there will be a cost for some arbitrageur to move money across these two markets, which means if the implicit price on the decentralized exchange moves a little bit away from the perfect price on the centralized exchange, they wouldn't take advantage of that arbitrage. We're going to go to an extreme and just assume there is no CEX for today. But if you want, it just imposes some bounds on the results I'm going to show you. It's not a big deal.
Do you have
Please.
Do you have any? I think you assume that there is no gas fees cost to update positions, right?
Correct.
Okay.
Correct. For today, there's not going to be any cost to actually making these changes. There's a question of how you might model that. I'm also not going to assume there's any transaction fee for trading on the DEX. I'm going to assume away all of those things just because they make the math ugly, but they're not really kind of fundamental.
Okay. And also
I'll come back. Sorry, I'll come back at the end if we have time for questions to talk about where I think gas fees can add some value to our empirics and our dynamics. But for now, I'm going to abstract from that.
And also transaction ordering as
yeah, we're going to bake transaction ordering in here.
Yeah, but I mean like it's
maybe I'll restate this. We're not going to worry about front running or slippage or any of those issues that people are also very worried about in these markets, right? That my transaction is public, that can cause MEV and lots of issues. We're not thinking about any of that in this context. This is like a pure analysis of the market making aspects, ignoring the other issues that we are aware that show up when doing these transactions on a public blockchain with a public memory pool.
Okay, makes sense.
Was that your question?
Yeah.
Okay, good. Kite, did you have a question?
I was just gonna double check because when you said no perfect arbitrage between centralized exchange index, I was thinking something like transaction fee that's causing the no perfect arbitrage because if the price only moves a little bit, the fee will prevent you from doing the arbitrage.
Yes. So that is what I have in mind, but I'm going to go to an extreme and assume zero arbitrage and not even model a CEX. So I'm not going to add limits to how far prices can get apart. So if you like, for the rest of the talk, you can think about this as two meme coins that don't exist on a CEX. But I think, again, within some limits, it applies equally well to ETH USDC. I'm not too stressed about it. So what are these tokens? I have to tell you about the assets and the information in our game. So each of our tokens, A or B, is going to yield, again, our game is in finite time for now. So they're going to, kind of the extension we're working on to post publicly is an infinite horizon economy. Don't worry about that. The assumption here is our tokens yield some terminal value, which for expositional kind of convenience, I'll define as the exponential of this dividend, DI cap T. And what is this terminal value, DI cap T? It's going to be the sum of some increments in every period, plus some residual noise that's token specific. Now, in your mind, what do I want you thinking about? I want you to maybe, although this is a little hand wavy, think about this terminal value as some future price, or better, I prefer service flow that you can get from the token. So there's some terminal date where, say, our market maker has to use their token for something. They have to run a smart contract, and that's it. And this is going to be the value they get from running a smart contract, if you think about this as ETH. Now, why do I have these increments? Why? That's going to be the realization of public information. This terminal uncertainty will normalize its expected value in exponential terms to be 1. But in every period little t, from the start of the game till the end, there's going to be some public news, YIT. We're going to model that as, if you like, a trinomial tree. This process can go up, down, or stay constant. So what we are trying to learn about over time is the terminal value of this token, say token A. And every period, we can get some good news. We think this terminal value has gone up a little bit. Some bad news, this terminal value has gone down a little bit. Or no news, the terminal value has stayed constant. So with probability pi hat, it's constant. With probability 1 minus pi hat over 2, it either goes down a little bit or up a little bit. Does everyone understand the logic we have in mind here? Every period, we're going to learn some public information, and that's going to influence our belief about this final value we get from owning a token. Again, Alice, as the market maker, is going to start the period with some beliefs about this terminal value. I'm going to call that mu-IT. It's her expectation of this terminal value given her information up until time t minus 1.
So just a quick question, the question of a period. So on an AMM, prices update continuously. What do you have in mind?
That's a good question. So what matters here in terms of the timing is kind of how often our market makers are engaging with the market. So the time period here really has that idea. So I want to think about, when I said there's a Bob who trades once against the market, think about that as a set of traders who trade, and then our market maker will be able to come back to the market. I'm not going to calibrate anything today, so I don't have a good answer for, is this an hour? Is this like, at the end, I'll come back to our model will generate some endogenous inactivity by our market makers. And so we could actually calibrate to fit how frequently they come to the marketplace if I fix a literal time period with some notion of discounting. But I'm not going to do any of that today. Okay, so that's a fantastic question. I wish I had a better answer. We're not there yet. But for now, I want you to think about it as like, I'm going to post some liquidity, maybe a month goes by, and then I come back and rebalance. And so a period is a month. But I understand there may be some arrival of news in the meantime. What is important here is that...
Well, I mean, I I guess I will say, you already admitted that, this is left for future, but I guess I will say the model I have in mind for liquidity providers on blockchains is that they're constantly watching. So they get updated at least, at the worst in granularity at the grain level of a block. So when a block commits, they immediately learn about it. And they're algorithmic, they're sophisticated. That's the mental model I have. They're sophisticated, they run, state-of-art computational platforms. They can react right away. So I wonder whether your mental model is indeed, they go away for a month or something like that.
I'm sympathetic to that. What disciplines me is this. Like, the market makers just don't engage very often. So at least over this window. Now, if I look at Uniswap v3 and I look at more recent periods, will that look very different? It could be. But for the period we were looking at, they're just not very active. They don't do very much. And so even if they're learning about every new block and every trade, there's a lot of inactivity going. Now, is that endogenous? They have or not? I don't know, but they engage so infrequently that I'm going to take them in that perspective.
Yeah, that's fair. That's interesting. I go by just talking.
I'm
to
with
these,
you, by the way. My anecdotal
talking
is
to these investors in conferences, to the people, and I know these
I
guys
agree.
don't sleep.
What I see in the data is a lot of inactivity, and so I'm going to think about them as inactive.
It's interesting.
Okay. So again, let me just highlight. MuIT is going to be the beliefs Alice has about the terminal value of these tokens when she enters period T. So it's her expectation as of time T, which only includes the information up to T minus 1. This is going to be the kind of key source of interest here. So when our market maker makes her deposit, her beliefs are this MuIT, which I'm putting in blue. Now, after she makes her deposit, the way we're modeling it, public news can arrive. In other words, our traders' belief about the value of the tokens will now be the expected value as of time T plus 1. They have learned the outcome of this trinomial process. Have the beliefs about the value of token I gone up, down, or stayed the same? Now, to make the problem interesting, and this comes back to Dali's question, like, why do you make this market? Why is there value here? Well, we assume the valuation of our trader, Bob, mu hat, depends on the news, the expected value of the terminal value, having learned the information, but it also depends on a private taste shock. So what does this say? Our trader can be trading against Alice for one of two reasons. They can be trading because they have superior information. That's going to look very expensive to Alice. That's why this term is in red. The fact that this expectation differs from Alice's beliefs when she posted the tokens, that's going to be a risk to Alice. She's worried that Bob will get some superior information and trade against her. What is the possible upside? Maybe Bob has learned nothing, but they just have some extreme preference for token A. And in that case, Bob isn't trading on information. He's trading for his preferences. He's a liquidity, I don't want to call him a noise trader, but he's a true liquidity preference trader. They have some extreme preference for some asset that has nothing to do with Alice's belief of the tokens. Alice makes money by supplying a market where this person can trade. And that's why that term's in green. Let me ignore this expositional assumption because it's just a detail. What I want you to take from this is we're going to write down the model to make the math as simple as we can. And so what we're going to assume is that if either of the tokens realizes a positive or negative news shock, we're going to model this so that there is no upside to trade with our trader. We're going to call this a pure informed trading event. All the reasons for trade is that Bob, the trader, has superior information to Alice, the market maker. On the other hand, when there's no news about either token, the only reason for trade is because Bob has this private taste shock. It's a pure taste or noise trading event. And so what is our liquidity provider going to do? They're obviously going to be thinking about, well, I have some beliefs about the value of the tokens. How much do I want to supply to this market to try to make money on the noise traders, understanding the more I put up, the more I might lose from the informed traders. We're really trying to bring now the logic of, say, Gloston Milgram, who helped us understand bid-ask spreads, into the language of automated markets. In Gloston Milgram, A market maker who is posting, say, an ask price, they're thinking about potentially selling the asset to a trader, is saying, why is this trader buying the asset from me? They could be buying it for random reasons, or they could be buying it because they know it's a good asset. And because if they're informed, they would only buy it if they know it's a good asset, I have to account for that. And so I have to raise my ask price up to protect myself from just giving away good assets for free. And so there, our market maker setting the ask knows they will lose a bit of money on the informed traders, but they hope to make it back on the uninformed traders. Here, it's the same logic, but of course, I can't set a bid and an ask price. What I can do is set the quantities of tokens I provide. So we're going to take this old trade-off from market microstructure and feed it into our dynamic model. And that's what we've done here. Now, what is the dynamic program we write down? I had this probability of news or no news. That's just pi or 1 minus pi. We have a finite horizon dynamic programming problem. In the last period of the game, our market maker has some tokens A and B, and they have some beliefs about the value of the tokens. They're risk neutral, so what is their payoff? They just get to eat the tokens. They get the expected value of these tokens. In any other period, what are they solving? They're going to choose how much of their tokens to put at stake, EA and EB. They are bounded by the amount of endowment they start with, capital EA and EB. And what happens? Suppose you put EA and EB at stake. Well, if you put EA and EB at stake, where will you end up next period? You know you're going to end up on the constant product curve. There will be some realization of trade. You're going to end up at some terminal values, XA and XB. How are those going to be pinned down? It's going to depend on the beliefs of Bob. Bob is going to come and trade at the market along this constant product curve and push you to some new portfolio, XA and XB. How does that affect you? You gave up EA tokens today. You end up the period with XA depending on the realized trade of the trader. You kept EA off exchange. So in the end, you have EA prime tokens tomorrow. You have EA prime tokens tomorrow. You start the next period with those tokens. It's the same for EB. And then you generate some new belief, mu hat T plus 1. Now, what is different between the two sides of this expectation? With some probability pi, there's a pure noise trading event. When there's a pure noise trading event, your beliefs, mu hat, are exactly the same as what they were when you started the period. With some other probability, 1 minus pi, the trade is an informed trading event. And what are your beliefs? You adopt the new beliefs of the trader. Your beliefs update. And so in one phase, your beliefs won't update. In the other, they will update. And you're going to trade off possible gains and losses from those two. So to make progress for today, I'm going to drop all the time subscripts and just do this in one period to show you all the economics in the paper. Okay? In one period, you're just going to supply liquidity for one period. It turns out if you do a bunch of tedious algebra, the problem simplifies into this form. You have a profitable object which scales with the quantity of liquidity you put on the AMM. The more EA you put, the more EB you put up, the more your profits scale. You have a loss function depends on how your values you supply differ from equal value in quadratic terms. Now, how do your profits scale? It depends on these terms. I'm not going to show you the ugly algebra, gamma U and gamma I. Gamma U is going to stand for the profits you earn on noise or uninformed trading. Unsurprisingly, that's going to be positive. Gamma I is going to be a term that depends on the kind of frequency of informed trading. Unsurprisingly, when there's informed trading, you're going to lose. And so what I want to show you just visually, very simply, is why these terms are positive and negative, and then I'll show you some results. Okay? What is the whole logic behind these terms? As we agreed, when you supply liquidity at a given point, this curve defines a relative price of these tokens. Imagine that point is also like our market maker's initial indifference curve. They have some belief about the value of the tokens. The slope is going to be those relative values. Now, our liquidity taker, Bob, is going to realize some new relative slope. Why are they going to realize some new relative slope? Well, they could have a very strong preference for token B. Or they could have learned token A has become really worthless. In either case, if they really love token B, or they believe token B has become worthless because of the arrival of public information, their relative values kind of become flat. So what is Bob going to see? Bob has this flat indifference curve, and he's facing this particular pricing curve. And so Bob says, if I wanted to buy 1 unit of B, I'd be willing to give up this much of token A. But the AMM is telling me if I want to buy 1 unit of B, I only have to give up this much of token A. So that looks like a favorable trade. And Bob is going to do it. Bob's going to start buying token B from the pool and adding token A. And he's going to do it up until what point? Up until the relative price on the AMM is equal to Bob's relative valuation. So what has happened? Bob has pushed our market maker into a portfolio that's much more extreme. It has very little of token B. It has a lot of token A. Go ahead, Dahlia.
Okay, so just clarification question. So if I understood correctly, your definition of expected profit relies on some external price information, which is potentially different from where the AMM is. And it does not take into consideration transactions that are pending in the mempool, which are visible to everybody, or any other sources of information. Is that right?
There's an interpretation of what the news about these prices, about these terminal values are. And so I can interpret that news as I look at the transactions pending in the memory pool, and that tells me something. But it's not telling me something about where the price on the AMM will be next period. That's not what we're using. So the question,
you're predicting what the real price is. You're doing
some notion of real
Oracle.
price.
Okay.
But again, if take as the example, like 2 meme coins that don't trade anywhere except at DEX. People just have to have beliefs about what they might get at some date in the future for them. And there could be public information. The creator of a meme coin is rug pulled, or it could be just people suddenly want it for some reason.
Okay, and that in itself is a big topic. I advise this company Chainlink, whose entire business relies on feeding prices reliably and dependably to blockchain.
So here we're not taking anything like that. We're just thinking people have beliefs about the relative values of these tokens. And in this case, my trader, they just wake up and they say, relative to the current price in the pool, I have different beliefs. And if they have different beliefs, they will want to trade. That's all that's happening here. Now, the deeper question is, well, how does Alice, the market maker, feel about this trade ex post? Someone has come along and traded. Does this make them better off or worse off? Well, if her initial valuation has not changed, she has not changed her belief about the value of these tokens, then from her perspective, Bob has taken a bunch of unfavorable prices. Our trader views these prices as favorable, but our market maker thinks they're trading at unfavorable prices. So in other words, if her indifference curve is like this dashed blue line, then what are we doing? We are pushing her through trade onto a higher indifference curve. She is profiting from this trade. If her beliefs have not changed very much because of this trade, or there hasn't been any public arrival of information, she perceives this trader trading for reasons orthogonal to her value of the tokens. This is like a noise trader from her perspective. This noise trader is paying unfavorable prices to her, which is making her better off. That is the source, that gamma U being positive. That is why by creating this market, she can profit even without any fees. Because there are these noise traders who are willing to trade at what she thinks of, she views it as noise. To Bob, it's not noise. To Bob, it's real. He just has a value for token B, and he's willing to pay for it. That's different from Alice's. And in all of market microstructure with heterogeneous beliefs, we see this all the time. If agents have different relative values of the tokens, we want a market where they can trade. That's at the core of our paper, is that fundamental force. Now, what could go wrong, of course, is this could have been a public news event where we suddenly realized token A is worthless. And because token A is worthless, Alice's beliefs have now changed as well. And so when I do the same analysis, our market maker's beliefs have now pushed her onto a lower indifference curve. And this trade has made her worse off. And that's the adverse selection or impermanent loss here. If, having realized the public information, our market maker could just withdraw her liquidity right away, she could get priority on chain and pull her liquidity, she would. And that's what I meant. We assume she's not capable of doing it. She's a slow transactor in that sense. And we think slow transactors more likely are the natural market makers in this environment, exactly because otherwise they'd pull their liquidity all the time. And then you wouldn't really know there's liquidity there. So I think this model also changes our perspective of who's likely to make markets, and it helps us understand a bit why we see them trade so infrequently. That's a graphical way to understand this result. Why can I rewrite this problem to say I can earn some profits on some sets of trades, the uninformed traders, but I'm going to lose by making the markets on the informed traders. And so we can see here that way those trade-offs work depends on this object. So if there's pi is large, there's a lot of uninformed trade, this term will be positive. If pi is close to 0, there's lots of informed trade, this will be negative, and our market will shut down. So first, market makers supply to the market only if there's enough uninformed trade. If there were always continuous arbitrage to this market in the absence of fees, the market would shut down. And that shouldn't be surprising. You can't make any money as a market maker in the absence of fees. So you can't sustain the market if you only have uninformed trade. Second, what I find interesting is this term, this quadratic term, yields some new insights, which is, well, suppose this is what we're used to thinking about. What is this term? Suppose I want to minimize this loss function. I set it equal to 0. How do I do it? I set the value of the A tokens I put on exchange equal to the value of the B tokens I put on exchange. That's something we have all heard by studying Uniswap, right? If ETH is worth $1,000 today, for every ETH you put on the exchange, you should put 1,000 USDC. Like that's in all the documentation. We can see a force pushing us towards that effect. You want to supply an equal value deposits because that minimizes this loss function. The problem is that loss is quadratic. But if this term, the profits from supplying to the market, is strictly positive, then by deviating from equal value deposits, you'll get a first order gain. So I like the math because it says, actually, as long as you can make money by making the market, supplying deposits in equal value is not profitable. You can do better by deviating from equal value deposits. So I might revise the conventional wisdom. This is a bit too harsh, I think, so don't take it too seriously. It's a bit quippy. Maybe I shouldn't do it, but it's, when do you deposit in equal values? Only if there are no gains to trade in the market. But in that case, the market shouldn't exist and it should shut down. So, what's happening here is you're trading off on the noise traders effectively. You're saying, I can protect myself from losses on noise trading by supplying an equal value, but you're giving up really big profitable trades when noise traders have extreme beliefs. And by supplying a little more liquidity away from equal value, you can take better advantage of them, but that assumes there's enough. That's the logic our model uncovers. I kind of like that idea, but I don't think I need to take it too seriously. I have a more general result. I'm not going to actually read this math to you. I want to come back to one point I made earlier. This is formal definition of the optimal liquidity deposit as it varies with the endowments of our liquidity provider, the fraction of informed and uninformed trading, and the values of beliefs. What I want you to take away are these bullets. First, we have linear preferences, so we expect and do find corner solutions. In general, liquidity providers are going to supply all of one of their tokens or all of the other of their tokens. That's not too surprising because I have two sets of linear agents. If I had risk aversion, we'd move away from that a little bit. People would want to be more interior. But if I push this linear model a little bit further, I want to point out, and this comes back to something I claimed earlier, in a dynamic model, we're going to start generating corner solutions. And then with corner solutions, we can generate inertia. Our liquidity provider will supply all of one of their endowments of tokens. If there's trade, they may stay at the same corner and not want to trade again. And so in our dynamic model, that's going to generate this inertia I talked about, that even if liquidity providers can update their endowments on the AMM period to period, they may not want to because they'll stay at a corner. So we generate an inaction region. They'll want to stay in the inaction region. As long as they do, they won't update. If they get a trade that pushes them outside of it, they'll rebalance back to the inaction region. I interpret this as a model. If I had gas fees to do rebalancing and risk aversion, then I generate the same inertia. So I actually don't mind this no gas fees and linear preferences. I think it's going to generate roughly similar dynamics. I'd have to quantify it to actually see how much that matters. I'm going to skip this because I want to be respectful of your time, which is just some other comparative statics. I want to take one note about efficiency, and then I'll conclude. I think it's a huge, important question. I think there are lots of ways to attack how these price schedules, these pricing curves should be designed. I just want to highlight our framework gives a bit of a new trade-off. which is that in a model with linear traders and heterogeneous beliefs, what you want to do is maximize the amount of trade. When you have convex prices, what you're doing is limiting trade. You're forcing trade to be less than would happen with what economists are used to, which is linear pricing. That's harmful. It's reducing overall gains to trade. So you'd want to reduce the amount of convexity in the price curve if you had, say, only uninformed trading. The flip side to that, of course, is with informed trading, convexity is kind of pushing you away. It's saving you from really extreme informed trades where you're losing all the value of your portfolio. And so our framework gives us a sense of how exactly that trade-off works. I hope when we publish the paper, you can read it and see exactly publish, but let me just say, post the paper publicly. If you're curious about this result, you can see exactly what I have in mind. I just want to give an ad for that's something that's coming out. We do some perturbations of the price function that let us study exactly how convexity trades off value in terms of gains to trade for our market makers. Let me try to just wrap up and tell you what we've done and leave at least 5 minutes for questions. So first, we're documenting something that I think should be unsurprising, and yet when we read the literature, we didn't see any documentation or people thinking about liquidity providers this way, which is that they actively set prices. At least in Uniswap v2 markets where we don't think of them doing it, we see it directly. Again, this is less surprising in v3 or I'm sure v4, where we're giving them the tools to set prices more finely, but even in v2, we see evidence of this. We've developed a dynamic theory of active liquidity provision. We argue using this theory that if there are limits to arbitrage with centralized exchanges, we should expect active liquidity providers to want to deviate from this equal value deposit rule. As I said in the paper, we try to show globally linear prices are typically suboptimal. You might want a little less convexity than the constant product curve, but you're not going to want to go all the way to global linear because of the forces of adverse selection. We're doing more work, as I say, going forward, trying to connect our dynamic model to empirics from Uniswap. So as I said, we're trying to quantify our dynamic model to ask how much inertia can we generate and under what conditions do market makers rebalance in the direction that trades have occurred, or do they rebalance in directions opposite to the direction trades have occurred? How does that differ across the pools we see? I think our model has some nice predictions and we're trying to see how far we can push it on that margin. As a broader question, I think this is actually something we all really should be considering, which is when it comes to crypto, beliefs about the value of these tokens, like there is no single belief about the value of these tokens. We don't have a great distribution we think is constant about the relative values of these tokens. And so I think taking seriously the idea of a robustness in terms of beliefs about relative values, can we do a form of robust mechanism design for AMMs? And does this framework give us a leg into doing that is something we're actively pursuing. Because I think it's simple and tractable and we can start thinking about, well, if I have to tolerate uncertainty in the possible distributions of relative valuations, what does AMM design look like? And so that's avenues for future work we're studying. Thanks again for having me and letting me join you today. I look forward if you have any last questions, but I just really appreciated this. Thanks.
Yeah, Robert has a question.
Go ahead.
Hey, can you hear me?
Yep.
Cool. Yeah, I have a question about active liquidity providers. So my understanding, I read a paper recently that it showed surprisingly that if you look in terms of markouts, Uniswap v2 is performing much better than Uniswap v3 in aggregate for liquidity providers. And some speculation is that basically Uniswap v3 has more flexibility for active liquidity provision, of course, because of bounded liquidity. Now, I know this is sort of orthogonal to what you were looking at, but do you have any speculation as to that?
I don't have speculation. The question I wonder if we're referencing the same paper that came out of the BIS like a week ago. But what I found striking was the differences in behavior of like large versus small LPs on V3. And what I would find really interesting is to understand, like, if I look at wallets that interacted with V2 and I classified them as active or passive, and then I asked which ones more quickly jumped over to V3. Like, I think there are dynamics across wallets swapping between which versions of Uniswap they're using that might shed some light into your question. That's how I was thinking about attacking that. I just haven't had time to do that analysis. But I think that
Okay,
would give us
thanks.
some insights, right? Who's more likely to take advantage of these more complex tools that look more like bid and ask pricing relative to V2? Is that predictable by their behavior on V2? So,
Hmm. Okay, thanks.
yep.
So I have two questions. First, just to clarify, so the result, the data that you showed in the beginning, so you're like, what you're working on right now is to show within this data that you see liquidity provider having a swap to see if it's go with or against the market price or whatever in the centralized exchange, kind of to try to see if it makes sense, right?
Yes.
Okay.
So what I'm curious about is, imagine a bunch of trades, remove token B and add token A to the pool. In a case of, I can tell you what I understand from our model. In the case of purely uninformed trading, if they push our market maker outside of their inaction region in that direction, they will revert prices back in the direction against those trades. So if I see an aggregate of trades and then a market maker swap is triggered, I should see the price adjustment go opposite some aggregate of all those trades. Instead, if it's an informed trading event, we would see a bunch of movement in the inaction region itself. And it's not obvious if our market maker will either be inactive or simply trade in the same direction as those trades. And so how our market makers respond and adjust prices in response to trading depends on like informed and uninformed trading. And I like that point because if we start looking at frequency of kind of swapping against trades versus not by our market makers, that might yield some insights into which markets are more or less likely to have informed and uninformed trading, which is an opportunity to go back. Agostino Caponi has a really nice paper where they try to identify that as well in the data. And they exploit variation in transaction fees, gas fees, paid by traders, with the idea being an uninformed trader doesn't care about priority because they're not price sensitive, so they'll pay low gas fees. And an informed trader is very price sensitive, so they might pay higher gas fees. And so I'd be curious how his way of identifying informed and uninformed pools is correlated with what our dynamic model generates. That's what we're really working on. Because I think that would give us a nice backup of, does the model kind of shed light on things we think we're seeing?
But I think like it was before Ethereum changed the priority gas fee mechanism. So
you have to be a little careful in how you do that. Correct.
yeah, but
I like the spirit of the exercise. Was my point.
Yeah, definitely. But two kind of things that I'm just thinking that may also impact is, first, there is competition between pools. So it's another like small impact that sometimes liquidity providers will give up in some sense the accuracy of the prices in their pool to make it be more attractive that the liquidity taker or traders will trade with them. So it's kind of also a little bit kind of complex environment that they want to give traders the attractive prices.
Mm-hmm.
And second point, I don't know if you heard about it, but one problem that people have in mind is liquidity providers attack, which is the following. It's more relevant to V3, but the idea is that if there is a bad prices right now, so there is a liquidity trader that want to, a liquidity taker that want to do a very big transaction and is a noisy trader. So there is a kind of a problem that maybe liquidity provider will see this, so we will insert a bunch of liquidity bundle in the bad noisy execution price that the trader willing to take, and then basically going to take all the profit from for providing liquidity relatively to all the other liquidity providers. So what's actually now many people thinking about doing is in the smart contract actually lock the like the option of liquidity provider to withdraw funds in a given time to make the dynamic of the story be that liquidity providers can't really impact prices in a small windows. So the smart contracts will basically will tell you if you want to either provide liquidity or withdraw liquidity, it always will be with some lag off to kind of try to make them be hands off of having a impact on prices right away. And which is also interesting things to take into account what's happened to your model if you do it and you kind of play around the timing of the model, which make it be a little bit more passive, or I don't know.
So what I can say is, first, I'm thrilled to hear young people like yourself excited to ask these questions. No, something none of you asked me about, which is 100% fair critique of our model, is like we have a single market maker. Like we are really thinking about like a collusive set of market makers who can choose their positions to extract the most rents from this market. It's because I don't know how to handle competition across market makers within a pool or competition across pools in this environment yet. So I'm thrilled by your questions because they're absolutely things that are valid and useful and worth studying. But we needed to start it at somewhere simpler I could make some headway on. We have abstracted away from all of those issues. What I find fascinating by your point, which is what I was writing down, is that if the response, like one way you are describing competition within a pool in V3 is by market makers shifting to kind of extract more of the rents from trading within a pool when a particular order comes in. And so in response, we're trying to limit their activity there, right? Again, it comes back to something we chatted about before the summit webinar started of, there's an elegance and beauty to V2 in its simplicity. And I wonder if trying to, even inside of that, market makers found ways to be active is what our evidence shows. They weren't as constrained as we might have thought to just take prices as given. But it does limit a lot of these shenanigans. Because now if you want to modify prices, one, you're modifying prices for the whole pool, and all the pool benefits from that. And two, when you want to modify prices, you're subject to the mempool transaction ordering. And so I wonder if maybe adding all these elements I think it's something we should all understand better. Like, are we improving it or are we adding costs that we don't understand? Or maybe from the user's perspective, this competition is better than if they could coordinate, right? Maybe this competition is making it harder in this. And so I'm glad to hear you asking these questions. I don't have, we can get there. So.
Yeah, interesting. Yeah, I think you summarized it very good. And the document of active liquidity providers in V2 is fascinating. So thank you so much.
Of course.
Kite?
I have a quick one-off question that's, I don't know, it's like, how big of the empirical part is this paper on the active liquidity provision?
I would say it's changing. And
Okay.
what I mean is, right now, like in the draft, we'll probably release in a week. It's a 3 or 4 page section that's motivating for a model. It says like, I think it's worthwhile to think about a model where market makers can set prices, and then we generate these ideas that maybe they don't want to just set at current market valuations, their liquidity. That changes how we think they can maximally support this market. Now that we have the dynamic model, what's going to matter a bit in terms of the empirics is how far the quantitative model fits some of these features. Can we use the model to push better to understand, do we see market makers behaving, their activity looking like what we would expect in markets with more or less informed trading, where we think we see more or less informed trading? Like maybe a Bitcoin ETH, a wrapped Bitcoin, wrapped ETH pool, there's more opportunity for informed trading than a wrapped ETH USDC pool, because you don't have news about both tokens, you have news about one token. You might start pushing on those margins, and the more we find there, the bigger the empiric quantitative section will be, the less we find. But I think that, in economics, I think having a bit more quantitative, meaningful dynamic model gives it a bit more legs for a more general interest audience. And so that's the reason we're pushing on those margins. I think if we wanted to send this where we've done some work with our great computer science colleagues to some of the financial crypto conferences, I think we'd probably button it off and send it off more quickly. But we're trying to get economists into this space. And so